Welcome to ZICA Academy YouTube channel. In this lecture, I will examine partnership accounts. If you are coming across my lecture for the first time, please like the video and share it with others. Thanks for watching ZICA. A partnership is an association that brings the talents and resources of two or more people together to carry on business in common with a view to making profit. An association that brings the talents and resources of two or more people together to carry on business in common with a view to making profit. That is partnership. So we want to look at the this of partners, this of partners, or partnership this of partners or partnership this. Partnership this is the document that sets out the conditions for the operations of the partnership business. The document that sets out the conditions for the operation of partnership business. That document is said to be the this of partners, or this of partnership, or partnership this. So what are the contents of partnership this? Contents of partnership this. Those items that it will contain. Number one, we have capital. This of partners will spell out how much each partner to contribute. It will spell out the amount that will be contributed by each partner. Number two, we have the profits or losses sharing ratio. The deals of partners will contain the ratio at which profits or losses will be shared between or among the partners. Number three, interest on capital. Interest on capital. The deals of partners will contain the rate at which interest should be charged on capital. It will contain whether or not interest should be charged on capital and the rate at which that interest will be charged. Number four, interest on drawings. Interest on drawings. The deals of partners will contain whether or not interest should be charged on drawings by the partners and the rate at which that interest should be charged. That will be spelled out. Number five, whether current accounts are to bear interest. Whether current accounts are to bear interest. The deals of partners will contain whether the current account will bear interest or not. So it will be spelled out in the deals of partners. Number six, whether remuneration to be paid to partner for their services. It will contain whether remuneration will be paid to partners for their active role or for their services. Remuneration may take the form of salary or commission. To take the form of salary or commission. So whether the active partner will be entitled to salary or whether commission should be charged or should be paid to any of the partners. All this will be spelled out in the deals of partners. Then the deals of partners will also contain interest on loan by the partners. Interest on loans by the partner. Any advance or advances made by the partners over their capital. So the rate at which interest to be paid on that advances or partnership loans. So that will be set out in the deeds of the partners. Apart from this number 7, and number 1, the rest of the items from 2 to 6, they will be dealt with in the current account of the partner. All these items will pass through the appropriation. They will pass through the appropriation. So you have them in appropriation section. Let me have appropriation. Appropriation. So the note 2 to 6 will pass through profit or loss appropriation. Absence of partnership deeds. How do you deal with the situations whereby there are no deeds of partners? Don't have the formal rules or regulation governing the partnership business. Number 1, profits or losses are to be shared equally. If there are no deeds of partners, you share the profits or losses equally among the partners. No partner shall be entitled to remuneration for their active role. No partner shall be entitled to remuneration for their active role. So you don't give any of them salary. No salary, no commission. No salary, no commission. No commission should be paid to any of the partners. No salary should be paid to any of the partners. No interest should be paid on capital. No interest. No interest on capital. No interest on to be paid on capital. No interest should be charged. Should be charged on drawings by the partners. You don't charge interest on their drawings. No interest on drawings. Any advances, that's number 5. Any advance or payment in excess of agreed capital shall attract interest at the rate of 5%. Any advance or payments in excess of their agreed capital shall attract interest at the rate of 5%. This will attract interest at the rate of 5%. Accounts required. The following accounts will be required in partnership accounts. Number 1, we have the statement of profit or loss. Statement of profit or loss, which is also called trading profit and loss accounts for the beginners. And the preparation of statement of profit or loss is the same as that of the sole traders. So for better understanding, you may go and watch my video on final accounts of sole traders or final accounts. Number 2, we have profit or loss appropriation accounts. The word appropriation in account means appropriation. The word appropriation in accounts means distribution. That is, profit or loss appropriation accounts. It's an account that shows the distribution of the partnership profit or losses for the period. It shows the distribution of income or loss or losses of the partners for the period. It's an account where profits or losses of the partners are distributed. The profits or losses of partners will be shared among the partners in their profits or losses sharing ratio. Remember, the profits or losses sharing ratio will be given unless there is no dis of partners. Where there is no partnership dis, I've told you that the profits or losses will be shared equally between or among the partners. Another word for profits or losses appropriation account is the statement of distribution of income. Statement of distribution of income. Statement of distribution of income. That is another word for profits or losses appropriation accounts. So, the format of profits or losses appropriation account will appear just profit or loss appropriation accounts. You have the debit side and the credit side. You may use the vertical form. Before this account can be prepared, you must have prepared the statement of profit or loss, where you will arrive at the net profit or net loss for the period. Where the statement of profit or loss shows a net profit, then you are going to bring down the net profit here. So you have net profit brought down. Then if it shows a loss, you have net loss brought down. Remember, the credit side is the income side. And I've told you, only the items that are spelled out in the deeds of the partners will be contained in the profits or losses appropriation accounts. The items of income you have in the partnership deeds, you have them at the credit side. The items of income you have in the deeds of the partners, the items of expenses you have in the deeds of the partners, you have them at the debit side. Any other expenses that are not in the deeds, you have them in the profit or loss account or statement of profit or loss or trading profit and loss accounts. Now, example of items of income which may be contained in the partnership deeds is interest on drawings. Interest on drawings. In order to prevent the partners from withdrawing an item out of the firm anyhow, interest is normally charged on drawings. Drawing is anything taken out by the partner for personal use. The partner who withdrew the items will pay interest on drawings. The interest paid by such partners is an expense of that partners, being an expenses of the partner, of that partner who pays that interest. You are going to debit the current account of the person paying it. Debit the current account of the person who is paying the interest on drawings. But To the partnership firm, the interest paid on drawings is an income to the firm. You are going to credit the profit or losses appropriation accounts. That is why you have interest on drawings. If you have partner A, interest on drawings, that will be then the total interest on their drawings. The debit side is the expenses side. So the expenses, items of expenses that may be contained in the partnership deeds include number one, salary paid to any of the partner who is taking active role in the management of the business. Salary. Let's assume A receives salaries. Salaries to A. If B receives commission to B. Remember, to these people, to them as an individual, it's an income. But to the firm, it's an expense. The firm is paying out the salary to A. That means to A, the salaries is an income to A. Therefore, you are going to credit the current account of A. The commission is an income to B. Therefore, you will credit the current account of B. While it is an expenses of the partnership firm or partnership business. So you debit their profits or losses appropriation accounts. That is for salary and commission. Interest on capital. Firm will pay the individual partners interest on their capital. So the firm paying that interest is an expense of the firm. That is why you debit the profits or losses appropriation accounts. But to the individual partners receiving it, it's an income. Therefore, you credit their current accounts. Interest on credit balance on current account. Interest on credit balance on current account. Where interest will be charged on the credit balance of current account, this must have also be spelled out in the partnership deeds. So where partner A is having a credit balance, so interest on it, the rate at which interest will be paid on that credit balance will be stated. So you have it at the debit side here. That means this interest will be credited to appropriation accounts of A. But where interest is to be charged on debit balance of current account, interest on current account debit balance. The person whose current account is having a debit balance is the one that will pay that interest to the firm. In that case, let us assume B current account is having a debit balance. So B will pay interest to the firm. In that case, you credit the appropriation account, then you debit B's current account. So at the end of the day, if the credit side of the current account, if it is greater than the debit side, that means you have a profit. That profit will not be shared between or among the partners in their profits or losses sharing ratio. So you have share of profits. A, B. Let us assume their profits or losses sharing ratio is ratio 3:2. That means 3, 2 for B. 3 plus 2, 5. That is 3/5 times the profits or losses. Why this will be 2/5 times that profits. So the amount of A, the amount of B, the total is this. So at the end of the day, the debit side will agree with the credit side. But where the debit side is greater than the credit side, you have share of loss. Share of loss. A and the B. The loss will also be shared in their agreed profits or losses sharing ratio. So that is the appropriation account. Then the next account is partnership current accounts. Partnership current accounts. This account contains the amendment. It contains the amendment in form of additions or withdrawals from the firm by the individual partners. It contains the amendment in form of addition. Let us assume you have B and A. A, B. If you are given the current account balance, if it is a credit balance, you have current account credit balance. If it is given in the question, current account credit balance brought down. Let us assume B has a credit balance. If it is a debit balance, current account debit balance brought down. Let us assume A has a debit balance. So you start with the balance, and in some question, the current account balance will not be given. But where it is given, you start with that. And it is possible both partners may be having a credit balance in their current accounts. Then the next item is drawings. You will have drawings at the debit side. Drawings is the amount withdrawn by the individual partners from the firm. Since it is a withdrawal, you have it debited to the current accounts in order to reduce the stake of that partners. But if it is an increase, you put it at the credit side. Then those items we have at the credit side here, remember to complete the double entry, I said you are going to debit them. You have interest on drawings, interest on drawings. Then interest on current account debit balance. Interest on current account debit balance. We assume B has a debit balance. Then we also have share of loss. Share of loss. Then those items you have at the debit side here, they will be recorded at the credit side. We have salary to A, commission to B. Salary to A, commission that goes to B. Then we have interest on capital, both A and B. Interest on capital, A, B. Then we have interest on credit balance of current account. That is A. Interest on current account credit balance. This is unusual. It's not common in question, but in case you have that, so that is A. Then Share of profits. Share of profits. A and B. After all these adjustments, you will balance the current account. Normally, current account is expected to have a credit balance. A credit balance is where the credit side is greater than the debit side. So that means you'll be having balance carried down here. The difference between the amount by which credit side exceeds the debit side is what we have as balance carried down. So the total then, if it has the balance carried down here, will be brought down to the next period. Balance brought down. What you have as CD here carried down is what you will have as brought down here. But where the credit side, where the debit side is greater than the credit side, that is mean the current account is having a debit balance. So the debit balance in the current account, balance carried down, you have it here. Let's assume A only is having a debit balance. So we have it, a balance brought down. That is A only. So that is for the current account. Number 4, we have partnership capital account. Partnership capital accounts. Partnership capital accounts. We have two types of capital account. We have fixed capital account and fluctuation capital account. Accounts. So fixed capital account. Under this method, the items that affect the partnership equity are adjusted in current accounts. That means where current account is required, the fixed capital account is also required. The major items you will have in current accounts here will be the fees amount contributed by the partner. The balance in capital account remains fixed unless there is additional capital. Unless there is additional capital or revaluation of assets or adjustment for goodwill are raised. The only circumstance where the fixed capital will be altered is where there is an additional capital or there is a revaluation of assets, which usually happen where a new partner is admitted or retirement of a partner. Revaluation of assets or adjustment is raised for goodwill. That is where your fixed capital account will be altered. The second account is fluctuation capital account. This account contains the fixed capital plus current accounts written together. That means your opening balance in that account will be the current, will be the capital. What you will have here as balance brought down will be the capital contributed by the partner. The fixed capital is what will be brought down to the credit side. The title will no longer be current accounts, but partnership capital account. That is for a fluctuation capital accounts. So this, after the capital, the next account is the statement of financial position or balance sheet. Statement of financial position or balance sheet. This will contain the assets, liabilities, and the equity of the firm. Now, let me give you the format of that. A and B. Statement of financial position as at, if the year end is December, as at December 31st, 20XX. So the use of vertical format will be presented in another video. You have the assets at the credit side. Number one asset is non-current asset, that is fixed assets. Fixed assets. So you have cost, accumulated depreciation, and net book value. Net book value. As part of our fixed asset, you have land and building, cost, accumulated depreciation, and net book value. Plant and machinery, the furniture and fittings. So, then, at the left-hand side, you have capital accounts. Capital accounts, let's assume a fixed capital account is maintained. You have A and B. The capital of each of them, the total, you have it here. Then current account balance. Current accounts. I'm assuming you are having a credit balance in current accounts. Then you may have non-current liabilities. Then you have current assets here. As part of your non-current liability, you may have loan notes, long-term loans or bank loans. Then you may have current liabilities. Current liabilities. Then you may have trade payables. You may have accruals. Bank overdraft. Let me say accrued expenses. Bank overdraft. Then, as part of our current assets, we have inventories or stocks. The total of this. Then you have trade receivables or debtors. Trade debtors. Then you may have cash at bank. You may have cash in hands. You may have prepaid expenses. Then the total of our current assets will be this. You have the current assets and non-current assets. You have your total assets. Then at the left-hand side, your capital plus current account plus non-current liabilities plus current liability will give you this at the total. That is the format of statement of financial position, balance sheet. Example, A, B, and C were partners sharing profits or losses in ratio 3:1. The partners were to be credited with interest on capital and charged with interest on drawings. The balances extracted from the books as at December 31st, 2021, after the balances on the nominal accounts had been transferred to the income statement, where we have the debit side and the credit side. Capital account A, 396,000, B, 420,000, C, 324,000. Non-current assets, 1.5 million. Profit for the year, 600,000. Bank balance, 240,000. The total of both the debit and credit sides of the trial balance is 1,740,000. No entries had been made in the books in respect of the following. 1. Goods withdrawn for personal use by B, 20,000 naira. 2. Business traveling expenses of 15,000 naira paid by C from private purse. 3. Interest on capital for the year. A, 15,000 naira. B, 20,000 naira. And C, 10,000 naira. 4. Interest on drawings for the year. A, 4,000 naira. B, 5,000 naira. C, 6,000 naira. 5. Cash drawings. A, 25,000 naira. B, 15,000 naira. And C, 10,000 naira. 6. B is entitled to salary of 60,000 naira per annum with 5% commission on trading profit after charging salary and commission. But before charging interest on capital, required. A, determine the actual net profit or loss for the year ended December 31st, 2021. B, prepare the appropriation account and partners' current accounts in columnar form. C, the statement of financial position as at December 31st, 2021. 8 years past 2, March 2024. Note, 8 years does not include the requirement in C. So this is not part of the requirement of the question. Now let's have the solution to the question. Solution. The name of the partners are, we have A, B, and C. The first requirement, you are to determine the actual net profit or loss for the year ended December 31st, 2021. So now let's have statement of adjusted net profit or loss for the year ended December 31st, 2021. So we have the debit side and the credit side. Profit for the year, 600,000 naira. So net profit brought down. We have 600,000 naira. Now let's go through the note. No entries has been made in the books in respect of the following. Since the following items have not been recorded in the books, that is to show that these items will need to be recorded in line with the double entry principles. Since they have not been recorded at all, we record them in line with the principle of double entry. Please take note of that. Now, note 1. Goods withdrawn for personal use by B, 20,000. These are drawings made by B. Since it have not been recorded, when goods are withdrawn, the drawings will take a debit entry. So we debit drawings account and we credit the purchase. But since the net profit have been extracted from the statement of profit or loss, instead of crediting the purchase, we are going to credit the statement of profit or loss. Because if purchase have been credited, the purchase figure will have reduced. And if purchase figure have reduced, then that means the profit will increase. No, purchase is an expense. The lower the expenses, the higher the profit. If purchase have been reduced by the goods withdraw, then that means the profit will have increased. So since it have not been recorded now, you are going to debit the drawings and then you credit the profit or loss. So we have goods withdraw by B. That amounted to 20,000 naira. Then note 2. Business traveling expenses of 15,000 paid by C from private funds. No, this is an expense. Expense should be debited to the statement of profit or loss. So in that case, you are going to debit the statement of profit or loss, then you credit the partnership current account. You credit the current account of C. So now debit the profit or loss. So we have traveling expenses of 15,000 naira. Then note 3. Interest on capital for the year. The interest on capital is spread out in the deeds of the partners. And I've told you that the items that are spread out, items that are specified, items that are contained in the deeds of the partners, I've told you those items will be used in the appropriation account. So in that case, this will appear in the appropriation account. Note for interest on drawings, it's also part of the requirements in the deeds of the partners. So we are going to use that in the appropriation account. Card drawings, this will be used in current account. No, it's not. It doesn't affect profit or loss. It's a cash that were drawn, and it is cash that were drawn during the period. So this will affect drawings. You debit drawings, then you credit cash, because cash is the giver. Cash is going out from the entity. Therefore, we are going to credit the cash account. So you debit the drawings or the partnership current account. You debit their current account. Note 6. B is entitled to salary of this. This is also part of the deeds of the partners. So that means these are the only items that will require adjustment in the profit or loss. So the total of the credit side is 620,000. So 620,000. Then adjusted profit, adjusted net profit, carry down. If you subtract 15,000 from the credit side, you'll be left with 605,000. So the total is 620,000. This is the statement of corrected or adjusted profit, or this is the profit or loss. That is the requirement A. Now, this is requirement A. Requirement B now. B, you are to prepare the appropriation account and partners current accounts. Now let's have A, B, and C. Profit and loss, appropriation accounts for the year ended December 31st, 2021. We have the debit side and the credit side. So the first item to start with is the net profit figure here, adjusted net profit. So we have net profit brought down. That is, we have 605,000 here. So that will be brought down here, 605,000. Then we now deal with the appropriation items. Now, note 3, interest on capital for the year. We have A, 15,000, B, 20,000, and C, 10,000. We have interest on capital. This will affect the current account. Current accounts. You have debited the appropriation, the partnership current account will be credited. Remember the double entry principles. For every debit entry, there must be a corresponding credit entry. You have the debit entry in respect of interest on capital in the profit or loss appropriation accounts. Then the credit entry will go into the partnership current account. You have three partners, A, B, and C. Partners A, interest on capital, 15,000, B, 20,000, C, 10,000. So we have A, 15,000, B, 20,000, C, 10,000. If you sum it up, 30, 45,000. The interest on capital is amounted to 45,000 naira. Now, note 4. Interest on drawings for the year, 4,000, 5,000, 6,000. Interest on the drawings. In order to prevent the partners from withdrawing goods or items out of the firm anyhow, interest is normally charged on drawings. So when interests are charged on drawings by the partners, to the partner making that withdrawal, the interest on drawings are an expense. But to the firm, that is to the partnership firm, interest on drawings is an income. So because it is an income, you are going to credit appropriation accounts. So interest on drawings. The debit entry goes to current account as well. Interest on drawings, you have A, B, and C. How much is it? A, 4,000, B, 5,000, C, 6,000. 4,000, 5,000, and 6,000. The total of these amounted to 15,000. 15,000. Back to the question. Then, cash drawings. I've told you when goods are withdrawn, when cash are withdrawn, the cash will reduce. Cash is going out. So you credit the cash account, then you debit the partner's current account. Note 6. B is entitled. Note this one does not affect appropriation. So that is why I'm not going to consider this until we get to current account. B is entitled to salary of 60,000 naira. A salary by B, salary to B is an income to B. That means you are going to credit B's account. That is partnership current account. The current account of B, you credit it. But to the partnership firm, the salary paid by the firm to B is an expense. Being an expense, you are going to debit the profit or loss appropriation account. So we have salary. Salary to B. And that amounted to 60,000 naira. Now back to the question. Per annum, with 5% commission on trading profit. So there is also a commission to B. Commission to B. So that commission hasn't been calculated. You were told it's on trading profit after charging salary and commission, but before charging interest on capital. You want to calculate the commission paid to B. You were told that B is entitled to commission of 5%, 5% commission on trading profit after charging salary and commission. The profit, that means the salary and the commission have to be deducted from that trading profit in order to calculate the commission. Please take note of this. Calculation, let me say working one. Calculation of commission to B. You were told trading profit. So we have adjusted net profit. That is from the requirement A. and we got 605,000 naira. 605,000 naira. Then we are supposed to subtract both the salary, because they say after charging salary and commission, both salary and commission are supposed to be subtracted. But we've not know the commission, so we less salary. And the salary to be, that amounted to 60,000. But we've not gotten the commission, so there's no way we can deduct that. 605,000 minus 60,000, that gives us 545,000. This is the profit before deducting commission. That is to show that the commission to be is part of this profit. This profit have two components. It has two components. One, we have commission to be, then other profits. These are the two components we have. This profit is made up of these two components. This commission, you have been told, the commission is with 5% commission. The commission is 5%. The percentage commission is 5%. Then this is always 100%. So that means this profit now, if you add these two items together, the profit is equivalent to 105%. That is 100 plus 5. 100 plus 5, that is 105. Then to calculate the commission now, commission to be, you know the commission is 5%. Out of the total profit is equivalent of 105 times the profit before the commission, which is 545,000. That gives us 545,000 times 5 divided by 105. That is approximately equals to 25,950. Let me round it down to nearest whole number, nearest 100. So 25,950. Then the commission to be is 25,950. Now, after this profit now, how do you know the credit side? If you add 605 plus 15, that will be 620,000. Then, how much is the balance here? 45,000 plus 60,000 plus 25,950. Then we have 130,950. The credit side is greater. Now you have 620,000 at the credit side. Then the debit side is total 130,950. And you want it to equal 620,000. 620,000. So you now subtract the 130,950 from 620,000. You have 489,050. 489,050. Now that is the profit. So now let's have it a balance brought down. 489,050. These profits now will be distributed among the partners in their profits or losses sharing ratio. So now let's have share of profits. We have three partners, A, B, and C. And what is their profits or losses sharing ratio? You were told A, B, and C were partners sharing profits or losses in ratio 3:1. 3 plus 2, that is 5. Plus 1, that is 6. That means 8 carries 3, B 2, C 1. 3, 2, 1. 3 plus 2, 5 plus 1, 6. So we have 3 over 6 for A, 2 over 6 for B, 1 over 6 for C, multiplied by the profit. And the profit amounted to 489,050 times 489 and 50 times 489 and 50 times 489 and 50. Divided by 6, this person will be 81,508 times 2, 163,017. For this will be 244,525. If you sum up that, the total will be 489,050. So, which agrees with what we have at the credit side, 489,050. 489,050. This is the appropriation accounts. In B, you have to prepare the appropriation accounts, which have been done, and partners' current accounts in columnar form. That means you have to prepare it together in different columns, in separate columns, not preparing A separately, B separately, C separately. Now let's have A, B, and C. Partnership, current accounts. In different columns, in separate column. So we have C, then B. This is separate column for B. This is for A. This is for description. Then C, B, A. Then this is A, B, C. A, B, C. Amount in Naira. You are not given the current account balance. You are not given the current account balance. So this is not current asset, this is profit, this is bank balance. So this now we have drawings, which comprises cash. Cash drawings: A 25,000, B 15,000, C 10,000. A 25,000, B 15,000, C 10,000. Then we also have drawings in form of goods. Drawings in form of goods. Goods withdraw for personal use, 20,000. So that is B. Goods. One by B, 20,000. Form of inventory. Goods. Then those items we've recorded in appropriation account, you have interest on capital. Debit entry goes to credit side of current account. So interest on capital, interest on capital. Interest on capital, A 15,000, B 20,000, C 10,000. 15,000, 20,000, 10,000. Then we have salary, 60,000. B. Commission, 25,950. Also to B. Salary, 60,000 to B. Commission, also to B, of 25,950. Then we have share. We have share of profit. Share of profit. Share of profit. A 244,525. B 163,017. C 81,508. A share of profit 244,525. B 163,017. And C we have 81,508. Now we've done with the debit side of the appropriation accounts. Then we go to the credit side. The credit side of the appropriation accounts, we have interest on drawings. Remember, for every credit entry, there must be a corresponding debit entry. Since this is at the credit side of the appropriation accounts, then you are therefore going to post this transaction to the debit side of the partnership current account. So interest on drawings, A 4,000, B 5,000, C 6,000. Interest on drawings, A 4,000, B 5,000, C 6,000. You were given business traveling expenses of 15,000 naira, which was paid by C from private purse. So I've told you this will be debited to profit or loss, and then it will be credited to C's current account. So we have traveling expenses of 15,000, and it was paid by C. So now let's total the current accounts. So 10,000 plus 81,508, that is 91,508 plus 15,000, that is totaled 106,508. Then for B, 20,000 plus 60,000, that is 80,000 plus 25,950 plus 163,017, that is totaled 268,967. Then 15,000 plus 244,525. We have 259,525. So the debit side here for A, we have 25,000 plus 4,000, that is 29,000. And the credit side is 259,525, which is greater than the debit side. So you have the balance carried down. Having balance carried down at the debit side here, it means the credit side is greater than the debit side by that difference. And that difference is called a credit balance. So we have credit balance of 230,525 for A. And the total remains 259,525. What you have a balance carried down here will be brought down here. 230,525. It becomes balance brought down. So 15,000 plus 20,000, that is 35,000 plus 5,000, that is 40,000. If you subtract 40,000 from 268,967, then you'll be left with 228,967. The total remains 268,967. So the balance brought down, carried down here becomes brought down here, 228,967. Then for C, 10,000 plus 6,000, that will be 16,000. Subtract 16,000 from 106,508. Then you will be left with the difference of 90,508. Total remains 106,508. So the carry down here becomes brought down here, 90,508. That is partnership current accounts. Then C, you are to prepare the statement of financial position as at December 31st, 2021. So we have A, B, and C. Statement of financial position as at December 31st, 2021. Then you have the debit side and the right-hand side. At the right-hand side, you have the assets. You have the assets. The first asset we have is non-current assets. Non-current asset. Back to the question. We were given non-current assets of 1.5 million. 1.5 million. Then at the left-hand side, we have capital account. Capital account. So they maintain a fixed capital. You have three partners, A, B, and C. So how much is their capital? For A, you have 396,000, B, 420,000, C, 324,000. A, 396,000, B, 420,000, and C, we have 324,000. And how much is the total capital? 396,000 plus 420,000 plus 324,000. The capital is total 1,140,000. 1,140,000. Then you have current accounts. Current accounts. You have A, B, and C as well. The closing balance, which is balance brought down, 230,525, 228,967, 9508, which is the closing balances here. For A, we have 230,525. For B, you have 228,967. And for C, we have 90,508. And how much is the total current account balance? 230,525 plus 228,967 plus 90,508. The current account is totaled. Let me recast. 230,525 plus 228,967 plus 90,508. We have 550,000. 550,000. Then we have current assets. Current assets. Back to the question. Capital account has been considered. Non-current assets have been considered. The profit for the year have been used in our adjusted profit. We have bank balance of 240,000. Bank balance. Bank balance. 240,000. Then that's all about the trial balance. Then goods withdrawal have completed its double entry. We debited the drawings or current account and we credited the profit or loss. The business travel expenses were debited to profit or loss and was credited to current account. Then we have interest on capital. It was debited to appropriation and credited to current account. Interest on drawings was debited to current account and it was credited to appropriation account. Cash drawings, 25,000. This was debited to current account. That is a single entry. The corresponding credit entry have not been recorded. If it is debited to current accounts, then that means the credit entry will go to bank account or cash accounts. So if you credit cash account, that means cash balances will reduce. So we subtract 25,000, 15,000, and 10,000 from bank balance. Now let's do that. Minus 25, let me say 240,000 minus 25,000 minus 15,000 minus 10,000. 240,000 minus 25 minus 15 minus 10. Then you'll be left with 190,000. 190,000. The salaries and commission were both debited to appropriation and the current account was credited. So that's all. So that's all about the transactions. Now, let's tithe. 1.5 million plus 190,000. That is 1,690,000. 690,000. Then the left-hand side. 1,140,000 plus 550,000. That is total 1,690,000. So our account balance. This marks the end of the solution to the question. My next video, I will consider a full work example that will start from the preparation of profit or loss accounts, the profit or loss appropriation, the current account, the statement of financial position. I will also consider the admission of partners, retirement or death of partners. Then I will consider the solution of partners. Please drop the love emoji and also share the video with others. Thanks for watching the ZICA.